This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenivek, live on Bloomberg Radio, television, and Bloomberg Originals.
And a very good afternoon, everyone, live from the Bloomberg Businessweek studio in New York. It is Bloomberg Businessweek Daily. I'm Tim Stenivek. That is not Carol Massar. Carol is out this weekend next. That's Lisa Mateo from Bloomberg this weekend. And you know what? She had so much fun yesterday.
She's back again.
Today. Not that you had a choice.
You didn't scare me. I'm good.
Okay, good. Well, we are happy to have you back. And you know, we talked yesterday a lot about Nvidia.
Yes.
And that's what today's trade is all about.
Yeah, I mean, they said revenue was going to grow 70% the next fiscal year. So that was a huge, huge launching off point for them. And you see it in the stocks.
Yeah, it's driving the trade higher today. We're going to get more details from Charlie Pellet on the trade in just a minute. In the meantime, on Nvidia, we've got Ian King joining us in just a few minutes. He's our semiconductor reporter. He's going to talk all about what Nvidia executives said on the call yesterday that got investors so bullish. Also, it's not just about Nvidia, it's also about Jackson Hole.
Yeah, and you have Tom Keene out there, you have Mike McKee out there, you also have Lisa Abramowitz out there, and they're going to have this whole live special tomorrow, but we're just going to be speaking with Mike a little bit later today.
Yeah, it's a tough assignment, but somebody's got to
Yes.
do it. Somebody's got to be in the mountains of Wyoming out there, you know. Yeah, we're grateful they're out there, and we're grateful
Yes.
they're going to be joining us in just a few minutes. We'll also hear from Jack Manley, a global market strategist over at JP Morgan Asset Management. We'll talk Nvidia, we'll talk macro and Jackson Hole with him as well. Nina Tretman is going to be joining us. She's from the CFO Briefing newsletter. We're also going to be speaking with the CFO of S&P Global on its mobility spinoff and on what all of that rating the AI debt has done for the company and will continue to do for the company. And our coverage, too, continues on that landmark settlement from Meta Platforms. So we're going to be digging into that a little later this hour. All that and more coming up over the next hour right here on Bloomberg Businessweek Daily. First up, though, a check of the day's trade and top business stories. Here he is, Charlie Pellet.
Hi, thank you very much. And the big question, will Michael McKee be wearing that cowboy hat or not from Jackson Hole? We'll find out a little later on right here on Bloomberg Businessweek Daily. Stocks higher right now. The Dow, the S&P, NASDAQ, all advancing. And we have got Nvidia shares rallying today. Nvidia after earnings now up by 8.9%. Our Ian King's going to have a whole lot more on Nvidia coming up for you in just a moment. But again, bears repeating. Nvidia, after last night's turnaround earnings report, right now up by 8.8%. You recall, as the number broke, we saw Nvidia shares sell off, rebounded after the conference call. Right now, Nvidia up by 8.8%. S&P up 51 now, higher by 0.7%. Dow Industrials up 123. That is a gain of 0.2%. NASDAQ up 1.3%. Nvidia driving the NASDAQ 100 index up by 1%. Also giving a lift to the SOX, the Philadelphia Semiconductor Index, up now by 1.5%. 2-year at 4.23%. The 10-year ahead of Kevin Warsh's remarks tomorrow, 4.67%. And the 30-year, 5.19%. Gold up $12 the ounce to $46.03, up by about 0.3%. And right now, crude is at $84.11 a barrel, higher by 2.3%. Brent back above 90.15, up by 2.6%. Among some of the other chip names today, looking at AMD, Advanced Micro Devices is down 1.9%. Broadcom shares, though, up by 3.3%. And perhaps getting lost in the shuffle here, we heard from CrowdStrike last night. That stock is now up by 19%. Salesforce, after earnings last night, up by 22%. But obviously the big story today, Nvidia. Nvidia bears repeating one more time, up by 8.7%. Lisa and Tim, that's a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Like you said, it is all about Nvidia today, up 8.7% right now. I want to bring in Ian King. He is Bloomberg News U.S. semiconductor reporter. He joins us from our San Francisco bureau. Ian, Nvidia adding more than $400 billion in market cap just today. Nvidia shares were under pressure before the call started yesterday. What did executives say on the call that changed the tone?
Yeah, no, you're absolutely right. They gave the usual good forecast. The reaction was sort of, okay, great, thanks. Stock down sort of about 2%, which is really the pattern that we've seen throughout the last few earnings. And then all of a sudden, Colette Kress, the CEO, comes on and says, look, 70% growth next year, which is compared to the 45% that Wall Street was expecting, and then says, And guess what? If we had enough supply, we could double.
Ian, did Nvidia do enough to talk about circular spending? Because today we heard about Nvidia reportedly looking to acquire Hugging Face. Did they do enough to talk about that circular spending?
Well, whether it's enough or not is obviously investors will decide. But what they did was give an extremely detailed breakdown of all of the commitments that they've made, whether it's commitments to future supply, whether it's kind of loan guarantees, whether it's helping out with the build of data centers, and they just spelled it all out. And the bottom line they said was like, look, in the grand scheme of things, if you believe in our growth and where we're going to be, this isn't a lot of money.
Hugging Face, does it make sense, Ian, for Nvidia to make an acquisition like this? I mean, I know Lisa just asked you about this deal, but it surprised me as well, because it seems a little bit out of the core business for Nvidia.
Nvidia has been pouring money into pretty much every part of what it describes as the AI supply chain, the layers that Jensen Huang, the CEO, likes to talk about. So anything that they're doing really shouldn't be that surprising, although one of the values of Hugging Face is this kind of marketplace, this kind of bazaar for AI models. So I'm not sure what Nvidia's ownership of that would bring and help it with, but they've been putting money to work everywhere.
I want to touch on hyperscalers for a minute. Did the company show that there's demand beyond hyperscalers?
Yeah, no, that's a very good question, and this was a key point that investors were looking for. This segment that they have in terms of breaking up their revenue of sort of smaller companies, startups, all of these, companies that aren't building these enormous data centers. And what Nvidia showed was that segment is now $40 billion of revenue, and it's growing faster than hyperscalers, which is definitely what investors wanted to hear from them.
Yeah, we knew it would be big, Ian. We had no idea it would be this big and lead to a rally such as this. Ian King, he covers it all out there if it's semiconductor related. He's U.S. semiconductor reporter for Bloomberg News. He's out there in our San Francisco bureau. Ian, thanks so much. Nvidia is the story with today's trade, but it's only part of the story. The other part is the Jackson Hole Economic Symposium. And that's where we find Michael McKee, Bloomberg Television and Radio International Economics and Policy Correspondent. Mike, the countdown is on to hearing from Fed Chair Kevin Warsh tomorrow. We're already hearing from Fed officials, though. You spoke with Kansas City Fed President Jeff Schmidt this morning. What did he tell you?
Basically that he's in favor of raising interest rates, that inflation has been too high for too long, and he doesn't think it's going to be going down fast enough, that the Fed is too loose and needs to tighten.
And tomorrow, of course, a big day. We have Kevin Warsh talking for the first time at the event. What do you expect he's going to see? I mean, is he going to talk about inflation? He's kind of been a little bit tight-lipped about it.
Oh, he's been very tight-lipped about it, and Wall Street has already protested by raising interest rates, certainly after his last news conference on July 29th. So there's division over whether he thinks he should say something to relieve Wall Street or just continue avoiding the subject altogether. It's kind of a question of what market reaction will be worse. My guess is he splits the baby in half and says something along the lines of, if inflation doesn't come down, of course, we will use all our tools to ensure it does so, without making any promises about when, not necessarily even saying what tools they would use, but just letting Wall Street knows that he's aware of the issue.
Mike, I'm going to throw a vibes question at you because you've spent a lot of time in Jackson Hole, not just at this economic symposium, but you've spent many years there. This one's different because it is Fed Chair Warsh this time. I'm just wondering, before we let you go, what are the vibes like heading into day 2 tomorrow?
Well, folks are just arriving here, and of course this is one of the most beautiful places on earth, despite the thunderstorms in the background right now. And so everybody's in a good mood. They're happy to be here, but there is interest in what Kevin Warsh has to say. I think you could categorize the other members of the Open Market Committee who've come here as not as concerned with what Kevin Warsh is going to say because they get their own say. And they are willing to say whether they support a rate increase or not. And many of them have said they do, like Jeff Schmidt. So it's a little bit different kind of situation than when you're facing a broad criticism of everything the Fed is doing, like Jay Powell did in 2022 when he had that 8-minute speech saying, we'll take all necessary measures.
Michael McKee, Bloomberg Television and Radio International Economics and Policy Correspondent. Mike, it's also thunderstorms here in the New York City area, so you're not missing much weather-wise. We appreciate your time, Mike, and we'll be checking in with you tomorrow as well. Let's stick with Jackson Hole and the Federal Reserve. I want to bring in Jack Manley, Global Market Strategist at JP Morgan Asset Management. He joins us here in the Bloomberg Businessweek studio in New York. Good to have you.
Yeah.
Do you think we're going to get any insight from the Fed chair tomorrow about the path of rates at the September meeting?
No, frankly, I don't. I think this is a Fed chair that's made it abundantly clear at basically every opportunity that he doesn't believe in that kind of forward guidance. And if you're looking for that kind of information, you're holding your breath. I think you're going to be very sorely disappointed.
Is that, in your view, a good or bad thing for markets?
I don't know if it's necessarily, I don't know if I want to ascribe a value to it. I don't know if it's good or it's bad. It's certainly different. What I do like, or what I can at least appreciate, is that we are going to see, I think, a lot more attention being paid to inflation as kind of the be-all, end-all for Fed policy decisions, and assessing, how do you accurately measure this stuff? What actually are we trying to target here? What matters? What doesn't? How effective can we be as an institution? Those are the things that I would suspect I want to call him Powell. It's like Warsh. It's really hard. I got to knock myself out of that. I was like,
you're not alone. Trust me.
Yeah, those are the things that I think Warsh is likely going to be addressing tomorrow, and that's in and of itself, I think, very interesting.
So, what don't the markets want to hear from Warsh tomorrow?
I think markets do want to get some sort of clarity on where rates are going. I think they're going to be disappointed. I think that they don't want to hear that rates are going meaningfully higher, and I don't think they will have to hear that. The inflation conversation, again, I think is going to be a little bit more nuanced. Warsh is treading a very difficult sort of line here where he has to be able to prove to the market that he is data dependent and an independent observer of what's happening with the economy. He will do whatever it takes. He will help to fight against inflation. But he also has to remember that the reason he has that seat is that he's planning on cutting interest rates at some point. Squaring that circle stuff.
Do you think he's going to talk about Treasury Secretary Scott Bessent at all and everything he's been talking about with the bond market? I
would imagine it comes up during any sort of Q&A portion,
and
you're probably going to get some answers to it, but I doubt Warsh is going to show that hand now.
He's been communicating as a member of the Fed for years. He knows how to do this. I think there were some people last month who maybe were caught off guard a little bit with the way he communicated during that press conference and following the most recent meeting. Are there any takeaways from like a communication strategy for trying to unpack the way that he communicates with markets right now?
Less is more is very much the name of the game. And again, I think I'm sort of sympathetic to that. And when I think about how monetary policy interacts with the U.S. economy in 2026, it's not even just this year. It's really over the past 5-10 years. What we have learned, I think, time and time again, is that 25 basis points here, 25 basis points there, 12 months of runway and forward knowledge doesn't actually do anything from an economic perspective, right? If the Fed tells you it's going to hike interest rates 6 months from now, and then it hikes interest rates by 25 basis points, what the heck is that going to do to inflation? What is that going to do to the labor market, to consumption? If the Fed actually wants to be effective at what it's trying to do, it has to take people off guard. It has to make those bigger than expected moves, and it has to make them when people aren't necessarily expecting. Now, that's an economic argument, though. When we talk about the market, it's a totally different story, right? The market wants as much information as it possibly can have because the market is trying to perpetually price out and reprice out assets looking long down the line. And when we think about how technology stocks have become more and more important in the U.S. equity market, these are inherently longer duration assets. Having a view on rates is critically important. But the Fed, even though a lot of us may think it does not have a responsibility to the equity market, at least not
It's not part of the dual mandate.
It's not part of the dual mandate, right? The Fed is looking at the economy, and from an economic perspective, all that forward guidance isn't super useful.
Well, you mentioned tech, so I want to go there. You mentioned tech earnings. Something you said in your note that stood out to me. The numbers here are so big, they make me dizzy. Okay, those are your words. What do you think about the AI trade? I mean, are you convinced?
So yes and no, which I know is like a wishy-washy kind of cop-out answer. Look, I mean, one of the things
how I got through college as a liberal arts
on the one hand, fellow liberal arts guy, I was a history major in school.
So was I.
I get it.
Kindred spirits here.
So when I think about the AI trade, one of the good things that we have going for it is that there is so much demand right now for all this compute and simply not enough supply that these contracts are getting inked for things that aren't even going to be made until 2 or 3 years from now. There's a long runway of fairly reliable revenue, and generally speaking, that revenue surprises to the upside. That's the way things have been over the past couple of years. That story cannot last forever, right? I would say that the AI kind of value chain has expanded a whole lot over the past couple of years, which is a good thing, right? It's not just the hyperscalers and one semiconductor manufacturer in particular. It is the broader semi-industry. It's CPUs and GPUs and software names. And look, there are banks that are financing this stuff, and energy names and materials and industrials. And like, oh, look, it's everywhere. And the chain makes sense. You know, the semiconductor names are making a lot of money because there's a ton of demand for their chips to generate the compute. And there's a ton of demand to generate that compute because the language models are in basically a 21st century space race. They need to spend to be on the bleeding edge. They'll pay whatever it costs. And enterprises are adopting this stuff quickly. And enterprises are adopting this stuff quickly because their shareholders are demanding it. But at a certain point, like, somebody's got to make some real money on this. And it has to be not like the chip makers. It's got to be the enterprises.
Meaning the companies that are using this technology to improve their bottom line.
That's exactly right.
So it actually takes us from the micro back to the macro and the question about productivity. And the Fed can't, Jay Powell was asked about this all the time and he couldn't give us an answer here. What is your answer for the productivity effect of this technology? Like, what is the promise here and what do you think it could actually deliver?
I am, generally speaking, an optimist on AI productivity. And I think maybe I have to be an optimist because A, I don't want to get fired, and B, at a higher level, talk about the macro, right? We have significant demographic drags in the U.S., right? You have an aging population. The baby boom is rolling out of the workforce. We've had some pretty aggressive adjustments to immigration policy that have resulted in working age population, in many cases, outright shrinking. You need to supplement that slowdown in the growth of labor supply with incremental additional productivity. And that is where AI on paper comes into play. I am not of the mind that AI is going to take everybody's jobs. I just don't think it works like that, because to me that is antithetical to the entire history of human commerce. Like, if you are a business owner and you're looking to, improve your output or at least improve your efficiency using new technology, are you going to fire half your workforce and make that new, smaller workforce twice as productive, and now your output has stayed the same? Or are you going to keep as many people on your payroll as before, give them new teams, and now you've doubled your output for essentially no additional money? I can see AI resulting in delayed and deferred hiring. I can see AI resulting in a net less demand for labor than there would have been in a pre-AI world. But I don't think we're heading into some hyper uninflation doom spiral thing. I think AI is going to be at least modestly additive to productivity.
Okay. We only have a minute. We only have 30 seconds left at this point, Jack. After Jackson Hole tomorrow, help us look past to sort of the next catalyst here. What is it in your view?
It all comes back to rates. It always comes back to rates. And
so the September meeting?
It's September, but I think more importantly, does energy inflation bleed into everything else? Because right now, if it's just energy, no big deal. If it bleeds into everything else, now we're talking about a different story.
And that gets us to the Strait of Hormuz and
exactly
what happens with policy there. Jack Manley, global market strategist at JP Morgan Asset Management, joining us here in New York. Jack, thanks for your time. Do appreciate it. Hey, taking a look at markets right now, the S&P 500 is in the green. Nvidia, also some of those SaaS names like Salesforce and CrowdStrike pushing the S&P 500 higher right now, 0.6% to the upside. But you do still have the vast majority of names in the S&P 500 lower, 339 stocks lower, 162 are higher today. Coming up next, we are talking to the CFO of S&P Global. That's next on Bloomberg Businessweek Daily.
It's 2:21 on Wall Street. We do check markets all day long. Here at Bloomberg, we have got stocks advancing. We're well off session highs now on the S&P, but still solid gains, looking at an advance of 0.6%. NASDAQ is up 1.3%. The NASDAQ 100 index up 1%. Dow Industrials up 0.2%. Stocks are rallying after that blowout outlook from Nvidia, spurred a rally in tech names, and that is bolstering confidence in the AI trade. So again, S&P right now is a baseline up 0.6%. We have got the 2-year currently yielding 4.22%. The 10-year ahead of Jackson Hole. By the way, complete coverage on Bloomberg. 10-year at 4.67%. Your 30-year 5.19%. Gold is up $14 the ounce, above 4,600, 46.05, up 0.3%. West Texas Intermediate crude now up 1.7%, 83.62 a barrel. Brent 89.74. Very close to 90 again, up by 2.2%. Bitcoin, meanwhile, just back below 80,000. Bitcoin up now by 1.8%, 79,900 on Bitcoin. Earnings news, Dollar Tree trading lower. It mostly met Wall Street expectations. It left its sales growth outlook for the year unchanged. Dollar Tree shares, they are trading lower right now. DLTR on the ticker down 3.7%. Dollar General has lifted its view on annual revenue after a quarterly sales beat. Dollar General up now by 3.3%. Recapping, Nvidia up 8.5% after earnings. S&P up 0.6%. Tim and Lisa, that is a Bloomberg Business Flash.
Hey, thank you, Charlie. Well, last month, S&P Global posted quarterly results. They fell short of analysts' average estimate, hurt by factors including the U.S.-Iran war, making it harder to boost pricing on contracts for its energy data news and analysis unit. At the same time, though, revenue from the firm's ratings business rose 17%. Revenue from its indices business, was up 20% year over year. That sets a little bit of the stage for this edition of the CFO Briefing. And for that, we welcome Eric Abwaf, CFO and EVP of S&P Global, the more than $130 billion market cap financial information services firm. You know it for its credit ratings, benchmarks, and of course, the indices. Also, the leader of our CFO coverage, Nina Trentman. She's Bloomberg News senior editor and editor of the CFO Briefing newsletter. You can subscribe to it if you don't already at bloomberg.com/CFO-briefing. A big welcome to both of you. Eric, I want to start with you. Your CEO, Martina, said last month that you expect $250 billion to $300 billion in debt issuance this year from hyperscalers or large tech companies expanding AI capabilities. I mean, we're talking about Nvidia today and the impact on the trade. I'm curious if we have any visibility beyond this year into 2027, 28, 29, 30, as we're hearing from some of these companies. What are you hearing?
We're hearing a number of scenarios, right? Scenarios that are at about the same level. Some higher, some a lot higher, right? And that's what keeps investors excited. But over time, we'll see. In a way, as CFO, my job is preparation, right? Preparation for those upsides, preparation to be there for our clients, preparation to make sure that our ratings teams are ready with methodologies that they've designed independently, and then supporting them as they go.
To follow up, maybe the AI-related borrowing that we've seen in recent quarters, of course, has smashed all records. Like, how far does S&P see a growing credit risk at some point?
It's hard to tell, and in fact, what we do is we help provide benchmarks and transparency to the industry. Right, think about the $45 trillion of debt that we rate each year. Right, that gives investors all the way from retail all the way to the biggest institutionals an ability to really understand what is going on in the space, both for the hyperscalers, the project finance they're doing, the data center builds, and in a way, that's our business, to create that transparency, that insight, and over time that gives them the tools to make better decisions. Forecasting the future is not what we do. Right, we try to help folks interpret what's going on today, what to extrapolate, what to explore, what to think about as upsides and downsides, and help them take it from there with the most trusted and valuable data that we have.
Yeah, I guess we're all curious to see what the future might hold.
I guess we have to ask the 8 ball again. Right. We don't know. None of us know. Go ahead, Nina.
If we all still have jobs in 3 years' time,
Thank you.
Who knows?
The robots will be doing this.
You made also significant changes to the portfolio. The company recently spun out its automotive business. I'm curious, talk to us about the considerations for that change, and also, is there more portfolio work that you're expecting at this point?
Yeah, we've been clear that we're done with transformational M&A. Right, we felt as we had navigated the last this goes back 2 years, that we had one area, the auto data mobility business, that wasn't as core to what we do. It didn't integrate with some of our other benchmark businesses, ratings, indices, market data, energy. It had different client bases. Right, and so it wasn't as core to the rest of the company. In some ways, was going to be more successful on its own. So we spent 15 months carving it out. That's a lot of work from a finance and CFO standpoint, but legal, comms, all the other the people team help with that work. And finally, on July 1st, we spun it out, and it's been a success. So we're real pleased, and now we feel like we're on our way, and they're on their way too.
Thinking about the IPO markets this year, do you regret, in hindsight, that you didn't choose the route of an IPO?
No, I think the most natural way to separate a unit is actually to spin, because what we do is effectively hand over the shares, literally the paper electronic shares, to our existing shareholders, and they can choose what to do with it. Right, and we didn't need the capital. We're a capital-rich company.
Right.
We create an enormous amount of capital. We've just upsized our buyback. We've got all the capital we need, and this was about doing the best thing we could for our shareholders, which is giving them the right to choose.
Well, a couple of things you've talked about. You've talked about M&A activity, hyperscaler issuance, refinancing. They've all supported ratings. So the question is, how durable is that?
We see a lot of opportunity ahead of us if you look at what we call the refinancing walls, right? The trillions of debt that we expect to refinance out of that $45 billion, it's quite high. It's at some of the highest levels that we've seen over the last few years. And so there's really a couple features. One is core economic growth creates a need for debt and issuance and rated issuance, which is what we provide. And part of it is you have a natural refinancing that's going on. And then that's supplemented by the ongoing M&A activity. We're in a period where we've got large M&A backlogs, lots of announced M&A, and so that's playing out. And we also have the hyperscalers coming through as well. But each one of those is a different sector. We have global, local, governments, mortgage-backed securities. We have a wide range. We have leveraged loans. We do both public and private debt. So in some ways, what we're trying to do is be there in all the market segments and actually help support those clients around across all those.
We're speaking with Eric Abwaf, the Chief Financial Officer over at S&P Global, and Nina Tretman. She is Bloomberg News Senior Editor and CFO Briefing Editor.
Thank you. Just wondering, thinking about AI, it's one of the topics that comes up in pretty much all of the conversations for CFO briefing that we have these days. Talk to us a little bit about how you're using it in the business, and also how you're thinking about ROI, which seems to be the biggest challenges that CFOs are facing at this point.
Sure. AI is really an accelerant for us, and primarily on the client and revenue side, right? First, we've been building AI functionality into our products so that as clients access the benchmarks and the vast amount of data that we have, they do it through a set of interfaces that they're increasingly moving towards. So we do it within our products and across all of our different products. There are different kinds of AI functionality that we're rolling out. We're also connecting directly with our clients in their technology suites, where they are tackling and adopting the LLMs, the frontier models, the open source models that range, and we're plugging directly into them. We've signed up on a kind of intercompany basis 500 of those clients. They're using AI more and more, and so in a way, it's a way for them to access our trusted data. Right, just in a different way. Historically, they sometimes used it, directly through, some interface that they used to. Over time, through APIs, right? So, which is computer-to-computer connections, and now through LLMs. And so, in our minds, it's just another access point, either through our own products and services, or through the new avenues that are open to them.
Eric, we just had this fascinating conversation with Jack Manley over at JP Morgan Asset Management, and a key question that we posed to him that everybody's trying to figure out is productivity as a result of these tools. Is there a way that, as CFO over at S&P, you've been able to quantify the ROI that you're getting from these tools, like how much you're spending and how much it's giving you?
Yeah, on the revenue side, what we're seeing is higher retention rates, larger pipelines, more usage, which over time comes back into our pricing structures and our economic value that we offer to clients. So we're seeing that kind of activity that can give us the information for ROI. And on the productivity side, there's a whole set of areas that we're rolling out AI internally to do what we do more efficiently, and those in particular are very well measured, because in a way what we want to do is just make sure that we're putting AI in the best use cases where we can actually get those returns.
What customers? What are they willing to pay more for today?
I think customers are willing to pay more for what is most unique and non-accessible generally on the web. Mm-hmm. Right? Our data is all within our ecosystem. Right, it's behind a set of walls, and even clients that want our data through LLMs and AI tools, it needs to be permissioned. Right, they need to have a direct link and account with us so that they can take advantage and benefit from our data, much like they do through the other venues that they source. And what we found is, the first step is we're encouraging usage, because usage begets value, and value begets over time product, service, expansion, a broader set of services that they're buying for us. In some product lines, there's direct offerings of AI-ready data that's curated and populated and designed in a way that makes it very facile for the large language models to benefit from. In other areas, it's part of the core service, but over time, as we renew with clients, we come back to them and play back to them, hey, here's how you're using our data. Here's how you're using our data through AI. As you use more of our data, let's have a thoughtful conversation about how you benefit and how we should benefit. And so it comes through over time as well.
Coming back to the cost part of the conversation, we know that companies across the US have found out that AI is actually more expensive than they thought, many of them blowing through their budgets halfway through the year. How are you managing token costs?
Well, the heart of the CFO job is measurement, right? Because measurement and information and what we call sunlight is a wonderful enhancement into what's really going on. And so we've got quite a bit of information that we've been building around the usage of AI, the token usage by division, by product, by our clients, by us. And then as we roll out AI tools internally, whether it's to our software developers who are able to add and develop software code and add product feature functionality, we're measuring how much more effective they are, right? As well as the amount of token usage. So to us, it's like other investments. It's something you measure, monitor, refine, adjust, right? Because that is the heart of what a CFO does.
And it's going to be a conversation that we're going to continue to be asking people like you about, because this is what it is all about right now. Eric Abwoff, CFO and EVP of S&P Global, joining us here. Also, the leader of our CFO coverage, Nina Tretman. She's Bloomberg News Senior Editor. She's editor of the CFO Briefing newsletter. Check it out at bloomberg.com/CFO-briefing if you are not already a subscriber. Coming up next, the latest on Meta platforms and that settlement. That's next on Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story headline right off the Bloomberg Professional Service. The two billionaire founders of Two Sigma Investments heading to another round of arbitration. It is the latest front in what seems to be intractable infighting at the quant trading giant. The $80 billion hedge fund has revealed the two disputes in a letter to investors that has been seen by Bloomberg. Now, one, initiated by co-founder David Siegel's family, centers on the resolution of a complaint brought by an ex-employee. Another concerns the future of the firm's management. The Dow, the S&P, NASDAQ were well off session highs, still holding on to gains after Nvidia results. S&P stands at 7718, up 42 points, a gain of 0.6%. The Dow right now up 86. That is a gain of 0.2%. NASDAQ up 323 for NASDAQ, a gain of 1.2%. The NASDAQ 100 index up by 1%. All of this as Nvidia surges today. Nvidia after earnings up now by 8.2%. 2-year 4.22%. We do have the 10-year 4.67%. The 30-year 5.19%. Gold, meanwhile, up $13 the ounce to $46.04, up by about 0.3%. West Texas Intermediate crude now up 1.9%, $83.75 a barrel. Brent, $89.91, up by 2.4%. We're keeping an eye on shares of Wendy's. The stock is trading lower today. We got Wendy's down after Reuters reported that Nelson Peltz's Trian Fund Management has no plans to make a bid at this time to take the fast food chain private. Again, recapping here, the Dow, the S&P, NASDAQ all higher. S&P up by 0.5%. Lisa and Tim, that's a Bloomberg Business Flash.
Thank you, Charlie Pellet. Well, we continue our coverage of Meta's landmark deal with state attorneys general across the U.S. in which the company agreed to pay up to $18 billion and implement design changes such as limiting the amount of time users under 18 can spend scrolling on its apps. Here's California Attorney General Rob Bonta and West Virginia Attorney General J.B. McCuskey speaking on this deal yesterday on Bloomberg.
This is a major breakthrough because when it comes to protecting our children's mental health, there is no time to lose.
It has always been our goal to make sure that every platform protects children in the same way that Meta is going to be protecting children.
That was California Attorney General Rob Bonta and West Virginia Attorney General J.B. McCuskey speaking on the Bloomberg yesterday. This news really got us thinking again about the Emmy and DuPont award-winning documentary Can't Look Away, The Dangers of Social Media. It follows a team of lawyers taking on tech giants, advocating for families whose children have been deeply impacted by social media. The original reporting of Bloomberg News investigative reporter Olivia Carville is throughout the film. Back with us is the co-producer and co-director of Can't Look Away, the case against social media, Matthew O'Neill. Matthew, good to have you back on the program. We thought of you a lot yesterday.
Glad to be back here. I think I've been hearing from people all over the country and the world with that settlement because it resonates so much with the themes in Can't Look Away.
Well, what was your reaction when you first heard about this settlement?
Obviously the headline of $17 billion seems like a lot, but the real meat of this settlement are the changes that are being made by Meta as part of the terms of the settlement. I mean, if you look at a lot of the allegations that the families were making in Can't Look Away, that endless scrolling caused their children to be addicted, that the companies were doing this on purpose, these are things that, again, Meta admitted no wrongdoing, but these are elements that are going to be changed on the product as part of the settlement, which is incredible.
Well, where does Meta go from here? Because we talk about the guardrails, right? They're going to be setting up some guardrails. But how are they able to find out the actual the age of kids? Because kids are savvy. I mean, let's be real. They can kind of get around different things. So what's Meta's kind of thought process as they go through this?
Well, I can't speak for Meta, but I can speak for what the terms of the settlement are. Yeah, in terms of they've committed to having essentially an inspector general of sorts that is going to look into this and using more cutting edge technology to root out and identify what 13-year-old, which users are actually underage. It's one of the points we made often talking about the film is that if they can figure out that I need a lawnmower or want to be advertised about Rogaine, they can figure out the age of their consumers, right? And so they're being held to that.
Too.
Yeah, good.
Ensuring, I want to read from a statement from Meta, quote, ensuring teens have a safe and productive experience on our platforms is an absolute imperative for Meta. We want to get this right for parents and teens. The company said this in a statement yesterday after news reports emerged of this settlement or what's going on with the state attorneys general. I'm wondering, Matthew, if you think you spent so much time with these families, you've spent so much time understanding what they've gone through, if this is enough.
I don't think that for the loss that these families endured, often the death of a child, there can never be enough. But having spoken with some of the families since the settlement, there is some salve in this in that their story, they're speaking out, they're being part of Can't Look Away, part of multiple lawsuits, talking to the AGs, being part of this movement, really, that has led to change. Their children's stories are going to make other children safer. And this is a huge step forward in this, because critical in this, the statements that used to come from Meta and the other social media companies always put the onus onto parents, what they can do, offering them products that were designed to be safer for teens. This settlement really puts the onus back onto the company, where the responsibility will lie with the maker of the product as opposed to the user.
Well, since you mentioned that, I'm going to go there. These changes are going to take some time. So what can parents do in the meantime to protect their kids? I know you have a couple documents, too, that go along with the film that you have.
Well, shameless plug. If you watch Can't Look Away, there is a watching guide, and it's in front of the paywall on the Bloomberg site so that anyone can access it, and anyone can access the Talking Points guide to watch it with their children. I just had a friend yesterday who bought his daughter a phone and said that one of the requirements was, she's entering 8th grade, was that she sit with he and his wife and watch Can't Look Away. And they had used those documents to have a conversation about it, because talking to your kids about what exists and what is possible on these platforms is really, really important. And I hate to, as I'm saying, don't put the onus on parents. I'm saying, parents, here's something you can do. I believe that these platforms need to be held responsible. Meta's now being forced to take a step in that direction. What's interesting about the lawsuit is that there's incentives that if the other social media platforms also settle, those protections for children become even more stringent, and there's an increase in the amount of money that's paid, so that this really could be the beginning of a shift for all the social media companies.
You say it's the beginning. It could be the beginning of a shift. What does the shift ultimately look like from your view?
Well, I think it changes the way that the companies rely strictly on engagement of children. They're being held responsible. It's the same thing that goes back to the tobacco settlement, of which many people have made analogies to the big tobacco settlement in the 1990s. It's not a perfectly fair analogy, but one of the things alleged in that lawsuit by the attorneys general was that the product was designed to addict people. And that's what was happening with tobacco. It was designed to have the maximum capacity to get young people addicted, to get you addicted. Adults can make that decision with open eyes. Children can't. That's also part of this. These products are being designed to addict children. And now these companies, specifically Meta, will be held accountable. And it really, really, I am hopeful will be the beginning of a sea change.
Now, this is going to be happening for U.S., for you people in the U.S. who use the product. So what about internationally? I mean, did you cover any of that in the film, what's going on around the world? Like, you look at Australia, they tried to ban it, and it just doesn't seem to work very well.
There have been a series of different legislative moves all around the world. In the United Kingdom, in Australia, not yet successfully here in the United States, although there has been movement in Congress, and bipartisan movement. It's one of those few areas where both parties agree there needs to be change. However, this is in the end, a financial incentive in their largest market, the United States. So that is likely to lead to design changes. I certainly hope it does for children all around the world.
Before we let you go, I'm just curious about if you're working on any sort of follow-up, if other projects that are relevant to this right now, very briefly.
The changing role of technology in children's lives is going to be the most urgent issue that we face. And it's not just about social media. You cover the big AI companies all the time, and we want to be telling stories that help make sure that technology is responsible in the way it's designed so that children can use it safely.
That's Matthew O'Neill. He's co-producer and co-director of Can't Look Away, the case against social media. He joins us here in New York. If you are interested in seeing the film and looking at the supplemental materials too, you can do that at Bloomberg.com. Bloomberg.com/features. That's Bloomberg.com/features.
This is Bloomberg Businessweek Daily with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.
It is Bloomberg Businessweek Daily. The S&P 500 up 0.5 percentage point right now off of its earlier highs, but still in the green. 149 stocks in there are moving higher, but 350 are moving lower. It's kind of illustrated when you take a look at the industry groups that are moving in the direction higher. It's just energy and information technology, but it's dominated by information technology. Everything else is in the red today. Lisa, it's about Nvidia, but it's also about what's happening in Jackson Hole. And on that, we have some new reporting from our Bloomberg News team out. Maria Eloisa Capurro out with a story about how Federal Reserve Bank of Boston President Susan Collins saying there's still evidence that the central bank's current policy setting is restraining the U.S. economy and helping slow inflation. Here's what she said Thursday in an interview with Bloomberg News on the sidelines of the Kansas City Fed's annual economic symposium. She says, quote, "I continue to see rates as mildly restrictive. The Boston Fed chief said she sees rates holding back smaller businesses and the housing market, even as she described the latest inflation data as mixed. She said the overall headline number was maybe a bit higher than I expected. At the same time, when you unpack it, it seemed more consistent with what I might have expected.
And this is going to be the talk all
This
day.
is it, yeah. This is it.
At the symposium.
Yeah, and we spoke a little bit earlier to Mike McKee, who's there on the sidelines. We also had Jack Manley, global market strategist over at JP Morgan Asset Management. We're going to be continuing our coverage of Jackson Hole. And of course, tomorrow, be sure to tune in to Federal Reserve Chair Kevin Warsh's his speech tomorrow morning. Be sure to tune into that on Bloomberg Television and Bloomberg Radio. Let's take a look at some stocks on the move today. I'm Tim Stanovic with Lisa Mateo. We're joined by Bloomberg News U.S. equities reporter Matthew Griffin. Hey, Matt.
Hey, Tim. How's it going?
Good. So far, so good. How are the stocks looking today?
Well, we can start off with one that's doing pretty well. That is Salesforce, ticker CRM. It's actually up 22% and trading at levels not seen since January, after the company gave investors a couple things to chew on that are soothing these AI disruption fears. So you had their revenue outlook for the current quarter, $11.5 billion, was above expectations. You also have this deal with Anthropic to integrate Salesforce's products into the Claude chatbot. And then another thing, you have the expectation for $1.5 billion of revenue from the Agentforce AI tool this year. It all adds up to soothe, again, some of these, what we sometimes call the SaaSpocalypse fears, and their CEO, Mark Benioff, actually spoke to this on the earnings call. He got right into it. He said the SaaSpocalypse is nonsense. Now, I don't think investors are fully giving him the benefit of the doubt on that yet. Shares are still down on a year-to-date basis, but this definitely helps.
I saw the SaaSpocalypse. I was like, how do you say that? Thank you for that.
I think that's right.
You cleared it up for me. I have a feeling you're going to stay on the AI theme with HPQ.
Yes, and here we're seeing maybe one of the dark sides of the AI rally in the broader market, which is these higher memory prices, because there's so much demand for memory chips. And today, HP Inc., that's ticker HPQ, down 4.5% after they reported that their unit shipments had fallen 16% in the PC business. The connection there is they've had to raise their prices in conjunction with those memory chips going up in price. And so even as revenue grew overall in the PC business, even as they gave generally good overall results and an outlook, investors are worried about what those higher prices are going to mean in the long run.
Yeah, I mean, if we think about it just from the consumer perspective, it means higher prices for us for certain products. I mean, look no further than what Apple announced earlier this summer, that they're going to be raising prices, and they have raised prices on certain products. We'll wait to see what the new iPhone tells us in September when we expect that to be unveiled and the price there. But yeah, prices are going up because these components are going up.
They are, and I've been thinking about getting a new phone and just kind of waiting nervously to see what happens.
Yeah, I'm due for a new one, so I know I'm going to be paying up. I probably have an older one than you, Matt, so I don't know. I kind of hold on to these things for a long time. All right, are we going to get a burger? What's going on here?
Well, investors in Wendy's, indeed, they might need a hamburger to cheer them up. That's ticker WEN, down 14% after a report from Reuters that Nelson Peltz's Tryon Fund Management currently has no plans to make a bid for the fast food chain. The reason that matters is there had been a report earlier this month that Tryon was planning a bid in coordination with some other investors, and now that you don't have that sort of takeout premium floor in the valuation, investors have to focus on the fundamentals here. That's 6 straight quarters of declining comparable sales. That's analyst expectations for those declines to continue. They do have a new CEO. We'll see if they can turn things around in their own, but right now investors are not happy.
And didn't the shares kind of spike up earlier in August because they thought this was going to happen?
They did. I mean, this looked like a relatively attractive takeout target. It kind of beleaguered stock. And again, now they're kind of on their own. Bloomberg Intelligence actually said that those same-store sales metrics, they could improve under the new leadership team, even without a bid. But this stock, it had been green year to date after that, the earlier report, and now today, back in the red, down 6% in 2026.
An entire discussion of Wendy's and no mention of a square burger patty. Okay, we'll do it. Square burger over at Wendy's. Matthew Griffin, U.S. Equities reporter for Bloomberg News. For more conversations like this, check out our Stock Movers podcast. They're 5-minute episodes on the biggest winners and losers in the stock market. Check out Stock Movers on Apple, Spotify, or anywhere you get your podcasts. If you're sticking with us on TV, the close is up next. Bloomberg Businessweek continues on radio.